I'm Howie Lim. This is Money Hacks by the Business Times. When markets take a nosedive, most investors freeze, paralyzed by the fear of making the wrong move. Others pivot to revenge investing, chasing losses in a desperate emotional sprint. If your portfolio is currently taking a hit, you're not alone. You're just human. But how do you stop the bleeding and actually get back in the game? Welcome to Money Hacks. I'm Howie Lim. Today, our guest, Grace Tay, Associate Director at Finexis, is going to try to help us separate emotions from strategy. Let's stop sabotaging our recovery and start investing with clarity. Grace, it's always good to speak.
It's good to be back. Thanks, Howie.
So during a period of market volatility, Grace, what's the one thing people rush to do in those first 48 hours that almost always makes the situation worse?
So the one thing that a lot of people rush to do is to panic sell, where they see a red screen, they feel fear in their gut, and they immediately reach for the exit. Unfortunately, selling does not solve the problem. In fact, it simply converts paper loss into a permanent one. So oftentimes, my recommendation is before you do anything to pause and ask yourself what is actually happening. Is it because of sentiment, because of a headline, a projection, a fear? Or is it something to do with fundamentals where the actual earning power of a company has changed and therefore you need to adjust accordingly? Oftentimes, when market crashes, it's because of the former, it's because of sentiment, but it tends to feel like the latter. And I would also like to say that sometimes panic doesn't set in within the first 48 hours. Right? Sometimes it's a slow burn where people hold, they hope for the better, but the market continues to drop. And eventually, the more they look at it drop, the worse they feel, and they eventually sell right at the bottom. In fact, the worst declines to sit through are not the ones that are sharp. It's the ones that are protracted. So for example, last year in April, the tariff crash was a sharp V-shaped scare versus what happened in 2022. The bear market was actually a long 9-month grind that broke far more people because of that extended duration.
All right. So what about the point in time that we want to go back in? That perfect time, so to speak, where you want to jump in after a crash. But let's be honest, maybe that waiting period, like you also said earlier, where people just held on to their stuff, right? That could actually be worse, would it? Would it cost our portfolios in the long run if we just sat and waited?
Yes, that's a good question. And I believe what we are talking about here is market timing. So a lot of research has been done on trying to time the markets. In fact, one of it done by JP Morgan showed that 7 of the 10 best days in the market happened within 2 weeks of the market's 10 worst days. So what this means is that in order to be successful in market timing, you need to have 2 things right. The first is you need to predict the bottom. And the second is you need to get in within that 2-week window and before the recovery happens. But the truth is nobody has a crystal ball, right? So if we actually make a mistake, missing the 10 best days would mean that our returns half versus someone who didn't try to time and just stayed invested. If we miss 20 days, that return drops to a third. So I like to quote Jack Bogle, who's the founder of Vanguard. He once said that in his entire 50 years of investing, he's never met anybody who knows anybody who can successfully time the markets. We can just look to investment greats such as Warren Buffett, David Swensen. They all call market timing a fool's errand. So if these legendary investors don't believe they can time the market successfully, then what chance do we have as mere commoners? Right?
How do we tell the difference then? If the portfolio is really in trouble, so red is not an indicator that it's really in trouble versus, it's just having a bad week, or it's really in trouble and we need to change investment strategy.
And that's the most important question in investing, something that people often get backwards. So they look to the market for an answer, but the market can't tell us whether or not we need to change our strategy. Only we can. I would go back to the 3 fundamental questions that we should always ask ourselves before we start investing. That is, what is the market for? How long until we need it? And how much of a drop can we stomach before it starts to feel uncomfortable? So basically, it's the 3 questions around what's your investment goals, what's your investment time horizon, and what is your risk tolerance. For example, are you investing for retirement or are you investing for kids' education? Is that in 5 years or 25 years? If the market drops 10%, is that something that you can shrug off, or how about a 50% drop? So if, let's say, you had answered these 3 questions honestly and nothing has changed, then a bad week in the market is simply noise, because market fluctuations don't change our strategy. That's simply what markets do, right? They fluctuate. And market crashes, in fact, are more common than we think. So data shows us that since the 1980s, corrections of 5% or more in a single week actually happens roughly every 14 months. And the very next week, more often than not, the markets are back up again. Even in a year where the markets end positive, somewhere in the middle, on average, you'll find a fall of 14%. So a bad stretch is not a malfunction of your strategy or your portfolio. It's simply the price of admission. And I also want to quote Benjamin Graham at this point, who's widely credited as the father of value investing. He said that in the short term, the market is a voting machine. In the long run, it's a weighing machine. So what that means is a bad week could simply be the markets voting on a headline, on a projection, on a fear. But our investment strategies are built for longer term objectives. So we shouldn't confuse the two. So when then should we change our investment strategy? That's only when something changes in your life. So for example, there's a new addition to the family, congratulations. Or perhaps your retirement goals have changed or your income has changed. Those are valid reasons to change the strategy.
Yeah, but what if it's just so uncomfortable? I want to get back to at least where I was before the nosedive, so to speak. Are you saying that we should never look to change our long-term goals, even if it's to try and break even again?
I would say it goes back to the 3 questions of why we are investing. And if the answers to these 3 questions have not changed, then there shouldn't be a need to change the strategy.
Still to come, Grace has given us a lot to think about already. How do we tackle that fear of getting back into investing? More with Grace Tay in a moment.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
And now, back to Money Hacks from the Business Times.
Welcome back. Grace Tay is Associate Director at Finexis. Grace, the urge to get it back fast is often strong, I'm sure. Is there ever a scenario where aggressive catch-up investing does work, or is that always a trap?
Well, there is a version of that works, and that is buying in when everybody is selling. In fact, that could be the smartest thing that any investor does. And it is how Warren Buffett built his wealth, right? He built it on this one line, be greedy when others are fearful. But here's the thing that most people miss. Buffett didn't buy in order to catch up. He had a plan to buy in even before the crash happened. He had cash set aside. He had a plan for what to do with it. But for a lot of us, we aggressively buy in out of emotions, or what behavioral finance calls get-evenitis. I'm not sure if you have heard this term before. Yes, but it's akin to like a gambler at a table doubling down on his bet to try to win it all back. Studies have shown that 3/4 of gamblers try to chase their losses this way. It's not so different in the markets. But the math is not so straightforward. So if we are looking at a 50% loss, we don't just need to make 50% to recover. We actually need to make 100% just to break even. So that's reaching for more risk simply to break even. And if that bet goes south, what we are doing is we are not filling the hole, we're actually digging it twice as deep. But the good news is that we don't actually need to play catch up because the market does it for us. The best days of the market sit right next to the worst days. So recovery is the default, so long as we don't panic and interrupt that.
What if we've often talked about how you shouldn't look so often? The more often you look, the worse it's going to look. But what if you haven't looked in a long time, just too scared? You need to face the music, so to speak, face the numbers and take that first step towards recovery, if you will. How does one get over that fear?
So first thing I would say is that it's very normal to feel fearful to confront the loss. Scientists call this the ostrich effect. And it's... Yes, and
head in the sand, is it?
Yes, correct. Yeah. And login data from the banks do back this up. It's been found that during a market crash, people stop logging in. So it's very normal. So the first thing I would say, the first step is to, before you open your app, take a piece of pen and paper and write down a date. Okay, so this is the date.
What kind of date? In the future or from the past?
Yeah, so this date is the date that you actually need the monies because we all invest for a reason. The question is, has that reason materialized? Because loss is often more terrifying without context. But a loss that sits next to, I don't need this monies for the next 15 years, will look very different. So I'll say write down that date before you open your app. And then once you do, take a look, breathe and close it. So you don't have to solve anything that day. You just need to get over not looking at it. And also, don't swing to the other extreme of starting to lock in 10 times a day. Because if you stare at a falling portfolio, it's only going to drive you to potentially do something that you'll regret.
Oh no. Is this emotional roller coaster, Grace, different for someone in their 20s or an investor that's near retirement?
I would say it wouldn't be too different. Looking at a portfolio that's in the red, our natural reaction would be fear if we don't actually understand what's going on. I use this framework that I call the reframe, reset, and reenter framework.
Okay.
And I would say it's the same framework that both an investor who's 25 and an investor who's 55 can use, just that their answers to it would be different. So for example...
Answers to what questions though?
So the questions of what does reframe, reset, and re-enter look like? For example, reframing the loss as information and not as a threat to identity. For a young investor, someone in their 20s, they are likely going to be buying assets for the next 30 to 40 years. So that information of a market crash is actually a gift. It tells them that they are able to buy assets on the cheap. It's on sale now. So market swings are actually their friend. It's not their enemy. On the other hand, for a near retiree, the same reframe applies. Loss is an information. It could be telling them that they are holding too much risk in their portfolios for their life stage. And it could be time to review the strategy. And then the next step, reset. Basically, the three questions that we talk about: investment goals, time horizon, risk tolerance. For young investors, the time horizon is decades, so you want to maximize compounding. For a near retiree, you actually have several time horizons. People often forget that they don't retire for a year, they retire for 20 to 30 years. So you need to have different pots of money, one for the immediate horizon, the first 1 to 3 years, the other for in 10 years, 20 years, and so on. So each of these pots need to be invested very differently. For my clients, we use this framework I call the Kueh Lapis retirement income framework that sets aside different streams of income for different time horizons. And then finally, re-enter. For young investors, I would say get back in, stay in, continue buying. Time forgives almost everything. Whereas for a near retiree, getting back in doesn't mean piling in everything at once, but it's really understanding how you are allocating. So again, set up the different pots, invest them differently. For example, the pot for the first 1 to 3 years should be in something that's stable, that's safe, that's boring, but it's there if you need it.
Okay. How fearful one can get, I'm sure, as an investor when they are terrified of buying back in at the wrong time. Is there a beacon of light out there that we can maybe spot when it comes on so that we know it is time to start investing again without needing to predict the future, obviously?
So the first thing I would say is I would take the fear off the table, because I think oftentimes that's built on something that's not true. So people are afraid of getting in at the wrong time. Okay, but I would like you to imagine the unluckiest person alive. Right, so this person for 20 years enters the market at the absolute worst time in the year. So when markets are high and then it crashes right after. Okay, so you imagine that 20 years on, this person would be a wreck, right? His portfolio would be perhaps even negative. But the surprising thing is, this person is still far further ahead than the person who was sitting in cash waiting for the perfect time to enter the market. In fact, nearly $200,000 ahead. So the lesson is this: time in the market is far more important than getting the right time to enter. So I would say, coming to the mechanical way that we can invest without predicting the future, that's called dollar cost averaging. Having an amount, pick a time in the month, and then automate your investments so that you are investing the same amount, the same time, no matter what the markets are doing. Whether it's up, whether it's down, whether it's sideways, you don't care. Because the system puts your money to work for you. It takes emotions out of the picture. So what this means is, when markets are high, you buy less. When markets are low, you buy more. Over time, your price averages out. Okay, so you don't have to worry about the perfect timing because you're not timing at all.
Yeah.
But I'll be honest though, because dollar cost averaging is not the best way to maximize your returns. Research has shown that the best way to maximize returns is to invest all at once, because the truth is the markets are up more than it's down. So having more monies invested sooner allows compounding to work in your favor. However, what I always believe is the best strategy is the one that you can stick to. So if, let's say, you can't stomach seeing your entire life savings drop when the markets crash, then the strategy is not going to work for you anyway, because you're not going to be able to stick to it.
Do you have some examples in what you do where somebody actually turned a crash into a win using your plan?
Plenty. Back in 2022, the broad market indices actually fell by nearly 25%. The growth and tech-heavy ones fell up to 40%. So most of my clients who stayed the course, they continued to invest. Today, they are sitting on profits of between 40 to 50% on average.
Yikes. Even after the drop of 40% for some bigger stocks, you're saying?
Correct. However, I do have one client who, despite my best efforts to allay her fears, she caved and stopped investing. Today, thankfully, her portfolio is still positive. It's up 10%. But it's simply a fraction of what she would have gotten if she had simply stayed the course. And
what could she have gotten had she stayed?
Perhaps similar to what my
well.
other clients have gotten.
Oh, nuts.
And I would like to say that is the whole lesson in a single comparison. And that is that a market loss does not determine our outcomes. Our behavior does.
Thank you so much for your time, Grace. You've given us lots to think about and lots to do.
Thank you, Howie.
Grace Tay, Associate Director at Finexis. I'm Howie Lim. This has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.